Hello everyone, welcome to our CEPR Safe European Policy webinar on reviving Europe's banking union. Today we're broadcasting to you on both Zoom and on Facebook Live. Good, that's worked. My name is Tim Phillips and I'll be moderating for you in the next hour. This is the latest in a series of Wednesday webinars from the CEPR on the future of Europe. Now, since 2014, the European Banking Union has transferred large parts of the banking, regulatory and supervisory framework to the euro area. And the effectiveness of this project, though unfinished, is going to be tested by the COVID-19 pandemic. So today our webinar's in two parts. First of all, we're going to imagine that the last 6 months never happened. I wish we could. And look at the progress made until 2019 and how the momentum towards banking union can be maintained or revived. And then we're going to look at the specific challenges for banks and bank supervisors in Europe post-COVID, given the framework that exists today. So joining us for this webinar, we have a great panel. Most importantly, everyone's important, but most importantly, we have Ignazio Angeloni of the Harvard Kennedy School of SAFE, and he's also the author of the CEPR ebook that inspired this seminar called Beyond the Pandemic, Reviving Europe's Banking Union. Ignazio, hello.
Hi, good morning, Tim.
Now, note Ignazio is one of the people who helped build up the supervisory arm of the ECB in 2012 and 2013, and he was a member of the ECB Supervisory Board between 2014 and 2019. And in the book, I note he says, I share some responsibility for what has been done. I don't know if he means that congratulate me, or if you want someone to blame me. We'll find out in the next hour.
Only for the good things. Only for the good things.
I thought you might say that. Also joining us today, we have Elga Bartsch of BlackRock. Hello, Elga.
Hello, good morning, everyone.
We have Mathias Dewatripont of ECARES, the Université Libre de Bruxelles, and the CEPR. Mathias, hello.
Hello.
And you were sitting on in many of the same meetings as Ignazio, weren't you?
I was indeed. It was my pleasure.
It's okay. Pieter Krahnen of SAFE Goethe University in the CPR. Pieter, hello.
I'm sorry. Good morning, Tim. Now I'm here.
I caught you out on being muted there. And now it's, for all of you, it's not a webinar if you don't ask questions. And we have a great audience today, both the number of you and the quality of the people who've shown up. So I'm expecting some really good questions. Use the button at the bottom to do that. If you go to that pop-up to ask your question, you see one you like or someone's already asked your question, vote it up and then it comes to the top and then we see it. Now, first of all, Ignazio, you're going to be presenting a little bit about what happened between 2014 and 2019. But I note that you say in the ebook that this banking union is a reform comparable in importance to the customs union, the competition framework, the single market, and the euro. So my first question to you is, really, is it that important?
The question is for me?
Yes, it is.
Otherwise, I wouldn't have written the book, you know. No, but really, I think that that is the case. It was, I think, felt already from the beginning that monetary union would not be complete without doing something to the banking framework. And unfortunately, the crisis of the 2008 and 9, and particularly the euro crisis later on, has proved that correct. And so I think that in itself, and also to support the monetary union, the banking union is critical.
Now, Ignazio, I'll leave you to present for a little while. First, you're going to be talking a little bit about, well, what's in the ebook, which is really the history of this project since 2014. Please go ahead.
Thank you very much, Tim. I'm going to be relatively quick because I want to leave as much room as possible to the discussion. First of all, thanks a lot, everybody, for being here. I'm really privileged to have CPR organizing this event and a distinguished group of panelists, let alone the audience, being here to discuss my work this morning. I'm really honored. Now, as Tim has explained already, this is really a script in two acts, pre-pandemic and post-pandemic. In the structure of the paper, in the structure of our discussion, and also in the way this work has developed. I started shortly after I left the ECB, so around mid-2019, with a couple of questions in mind. First of all, has the banking union been successful?
Ignazio, I'm going to break into your flow here. Don't forget to share your screen.
Oh, sorry. Yeah. Well, that was just an introduction, but here you get it. You see it?
Not yet.
Oh, one moment.
There we go. That's perfect. Thank you.
That's very nice. So 2 questions. First of all, has the banking union worked? And whether it has worked or not, I think has to be assessed in relation to the initial ambitions. And second, if the answer is no, or to some extent no, then what can we do about it? And I thought at the time, still think, but particularly at the time, that the questions were timely. First of all, because 5 years' time, the ECB supervision started in 14. So 14 to 19 is 5 years. 5 years' time is more than enough time for the structure to prove its worth and for the authorities within the structure to prove its worth. The ECB in particular, in those 5 years, has done 5 complete yearly supervisory reviews of all banks, and including recommendation and requirements for the banks to follow after those reviews. And so we should see the mark of what has been done. And the Single Resolution Board has been there for a little bit less time, but still a number of years. And so we should see the result at this point. So it's time for an assessment. And second, last year, as you remember, we had a new commission, a new leadership of the European Central Bank, and the new European Parliament. And so it would be, in a sense, an ideal time to look at the situation afresh and trigger policy action if needed. Now, right after I was about to finish this work at the end of last year, very, very early this year, and then coronavirus struck. And so there was a moment of panic for me. I said, well, I have to redo everything. But then I thought, no, I think the long-standing issues, if there are going to come back. The virus will, and of course the economic impact of the virus will make the situation worse, will hit the bank very significantly, but there will be policies to protect for that. And over the medium term, the long-standing issues will come back. And so hopefully my point will remain relevant. So,
don't forget to move your slides forward. There we go.
I forgot to move the slides. Yes. No. This is it's basically in 2 parts. So there is a diagnosis, what the problems are. This is section 2, and there is a section 3, which is on therapy, what to do. Let me start quickly with the diagnosis. I have adopted 3 criteria, thinking about the initial ambitions, as I said. I looked at 3 criteria to see if the banking union was successful. First of all, whether it made the banks safe and sound. These are keywords in the supervisory culture. Making banks safe and sound is in the statute of every supervisor, and indeed it's in Article 1 of the ECB supervision. So that's number 1 in a sense. Safe and sound means a number of things. We will see that. Second, making banks efficient and competitive, which overlaps with the first, but is not the same thing. I mean, you can have safe and sound banks which are not really efficient and cannot compete effectively in the global playing field. So that's a little bit more than that. And then third, maybe it should be first, since we are in a union, in a European Union and a banking union, integration. So the fact of the banking union being such, not only in the institutional architecture, but also in the reality of the marketplace, of the banking marketplace. And you can see my, to make the story short, you can see on the right-hand side, my summary assessment. Making banks safe and sound was significant progress, but incomplete. Making banks efficient and competitive, little or not at all, with respect to a number of years ago. And likewise, area-wide banking integration, as little or not at all. Now, there's a bunch of data in section 2. If I cannot go through all this data, obviously, I'm going to jump over the issue of efficiency, competitiveness, and integration completely. I hope you have seen some of the data that I report in section 2. And I will concentrate a little bit on safety and soundness of banks. But before saying that, let me say there's another criteria which I think is relevant. It's not up at the forefront, but it's also relevant. The fact of improving the quality of supervision. The supervisory landscape before the banking union was very fragmented. The quality of supervision was uneven, let me put it this way. And I think it's a fact, I'm not going to discuss this further, there's more in the paper, but I think it's a fact that the quality of supervision in terms of transparency, in terms of even-handedness, in terms of accountability, has improved significantly. But let me move to making banks safe and sound. I think there are several dimensions to that. One is solvency, the fact that capital is sufficient. In quantity and quality, the question of asset quality, so the issue of whether the banks have reabsorbed the volume of non-performing loans and risky and toxic exposures that they had accumulated during the crisis and before. And the third is the so-called famous doom loop. So the fact that the banks depend on sovereigns and the sovereigns depend on the bank, and there is a reciprocal channel of contagion between the two that brings instability. So these are three dimensions of making banks safe and sound. Let me say something on my assessment on each of the three. So on solvency, I think there was very good progress, but particularly at the beginning of the period. So 2015, 2016, to some extent 2017, and after that it has a little bit stalled. What happened then? Well, my recollection, maybe Mathias can help me, but my recollection is that at that point in time, there was considerable pushback from the banking community. There was a discussion also with the Commission, and that was the time in which the Pillar 2 requirements by the supervisor, by the ECB, were split in two parts. The so-called requirement proper, which is mandatory, and the guidance, which is not mandatory. Now, after that, the Pillar 2 requirements of the ECB have not increased at all. And so that was a moment in which essentially the stringency of supervision became much less than it was before. And there is another thing. That was also the time in which we understood that the ECB would not use proactively its macroprudential tools. And in particular, the countercyclical buffer, which is a critical tool in the macroprudential toolbox, which ensures that the accumulation of capital increases in an economic recovery in order to be softened, in order to be reduced in an economic downturn. That was the time in which the countercyclical capital buffer should have been used more, and it wasn't. We can discuss that further. In terms of asset quality, there was, I think, great success. I mean, the numbers speak for themselves. There are lots of data in the paper to show that there's been a dramatic decline in non-performing loans, and also other assets of dubious quality or dubious liquidity in the portfolio of some banks have been reduced considerably. There was strong opposition, let me tell you, to that process, not at one point also by the European Parliament, which went against the ECB. But in spite of that, I think the progress has been very considerable. The doom loop, which in a sense was critical, I remember that the statement of the Euro area leaders in 2012 put removing the doom loop up front as a goal of the single supervision in the banking union. So that was very important. That was one of the factors behind the Euro crisis. There, I'm afraid to say, there's little or no progress. Let me move on the next slide. I'm going to show only this chart in the whole presentation. These are scatter plots that show dots. Each dot is a combination of bank CDS and the respective sovereign CDS. So measures of risks combined of banks and sovereigns. And we have seen two charts. On the left is before the banking union, and the right is after the banking union, the most recent data that we have. So if you see a positive correlation in those charts, it means the doom loop is still there. Now, what do we see? We see that on the right-hand side, the dots are much more concentrated towards the zero. So it means the banks are more stable and sovereigns are more stable for a variety of reasons, last not being the monetary policy of the ECB plus other things. But the positive correlation is still there, as you can see. So that means that we still have the doom loop. I have to mention here that there's been some evidence that has shown that the doom loop of risk between sovereigns and banks does not depend on the extent of sovereign exposure in the portfolios of the banks. In other words, if you look at the cross-section of banks and you try to, and you rank them by how many sovereigns they have in their portfolio relative to their assets, and you try to find the link between this and the doom loop and how sensitive they are to the sovereign risk, you do not find that correlation. So that correlation comes from somewhere else. And I would venture saying that this comes from the fact that the banks still now, even under the banking union, depend on their sovereigns for support in a crisis. And so, you know, those who have to invest in bank assets and those who take positions in CDSs know that this link exists potentially. The link is more serious if the bank is in trouble, and that's what brings the doom loop in. So this is one of the elements, and here I'm heading a little bit towards my conclusion. This is one of the elements, among others, that suggests that we should not look primarily at how much exposed to sovereigns banks are, but we should look at the crisis management structure if we want to fix what seems not to be working. And let me move here towards, all right, so this is the therapy, section 3. I adopt 3 guiding principles, which I think descend from the data that I show in the preceding section. The guiding principle is basically, I'm oversimplifying here just to be illustrative, but first of all, we should reduce overbanking. There is overbanking still in the euro area, in certain countries and certain segments particularly. We should reduce it, but we should reduce it among the weaker players. And that's where we need a good crisis management mechanism. At the same time, we should foster efficiency and consolidation among the stronger ones. And at the same time, we should encourage cross-border diversification of banking. So these are the 3 guiding principles. And I've tried to break this down in more concrete proposals, which are in the paper 1 to 8. And here in these slides, I group them. I group them by analogy. And we have an area 1. The area 1 is crisis management powers and responsibilities. I think it's very important, and here I move to number 1, very important that the SRB, the Single Resolution Board in Brussels, acquires more powers along the lines of the powers of the American FDIC, the Federal Deposit Insurance Corporation, which is a very good, a very effective organization that possess a certain number of powers that the SRB doesn't have. And I'm referring in particular to 3 in the paper. There is an annex that gives more detail, but basically the FDIC has the power to receive a bank, so the receivership, but basically they get it on board, and from then on they are responsible for the liquidation of the bank itself, the resolution, and choosing the instruments and giving support, etc., etc. They take primary responsibility for that. Second, important, they should possess a significant degree of discretion in the use of funds, in the use of resources to execute a resolution. And third, something which is a little bit more hidden, but has been critical in the US after the crisis, the FDIC can the FDIC can directly negotiate with the acquirers, with the healthy institutions that are going to buy the bank or parts of the bank, and they can give certain sweeteners to the acquirers in order to facilitate the resolution of the bank. So all these things are very useful, and I think they can serve as a model. Second, the SRB should directly resolve all the ECB supervised banks. And the emphasis here is on directly and all. Directly meaning that it should do it on its own, not simply supervising what the national authorities are, as now the BRRD, the legislation foresees, should do it directly and should resolve all, if needed, of course, not all of them, but all the ECB all the what we call the significant banks, which are the banks supervised by the ECB. So far, only one of the banks that have been resolved or liquidated, significant, during the period of time under consideration, only one has been actually resolved in a relatively rapid way, I have to say, but by the SRB, all the others have been left to national authorities. So you have the paradox, in a sense, that a bank that is considered significant, so euro area-wide relevant in life, so it's supervised centrally, then when it comes to being liquidated, when the resources are being tapped, it goes back to the country. So this is something that, in my view, should not happen. Different for the smaller banks are the less significant, as we call them. This is a national supervision, direct supervision, and national liquidation. But there we should have harmonized rules, and the SRB should oversee the application of those rules at the national level. So there again, the national authority should not be left alone, but should be supervised by the SRB. The second group, resolution funding. First of all, I think that in some cases, the bail-in rules and the state aid rules have proved to be too rigid in these 5 years, in a number of instances. So I think there should be circumstances in which the state aid is allowed more flexibly, more freely, largely under the discretion of the SRB, of the resolution board. And I have in mind in particular two cases. One, when the bank exits definitively from the market. So there's no competition issue there. The bank is out. That's one. Second, when there is a full and rigorous AQR, asset quality review, together with a stress test. So one is sure that the bank is clean. So when it goes back to the market, we have a good bank and not one on which some dubious, some questions persist. Now we have seen the opposite. In fact, in a number of circumstances, we have seen banks that have been helped with precautionary capitalization following a stress test only. The stress test only without asset quality review cannot give you certainty that the bank is clean. So I also think that it's important that the national resolution and deposit guarantee schemes are fully funded, and also they should be independent from the national supervisor. This is not always the case. And they should be fully funded simply because if you have to tap the resources at that point and you have to charge other banks, the healthy banks, then you may be reluctant to do that because there can be contagion. Okay, so you have a situation in which one bank needs to be resolved or liquidated nationally, depending on the size. You have to tap other banks. People may doubt that the system can easily bear that. And so if the institution is funded in advance, that doesn't happen. The third area relates to the ECB. Both the supervision and the macroprudential. Macroprudential, I've already spoken. I think should be used more proactively in an area-wide sense. But also, there's a little bit on the supervision. In particular, the legislation still contains, and some of them have been introduced actually recently, obstacles to the operation of Pillar 2 supervision, limits to the possibility of the supervisor to apply flexibly with discretion Pillar 2 supervision. I think those should be removed, as should be removed the national options and national discretions that still exist that give the national governments some leeway in the prudential area, which is an area that, in principle should be part of the banking union and not left to national politicians. Moreover, that's the end, number 8, encourage diversification of sovereign portfolio. I think this is a medium-term plan. I think we have to do it cautiously. This chapter should not have the emphasis that it does have in the public discussion so far. Should not, because the sovereigns, after all, are a key, keystone for the functioning of the financial sectors, and I don't think that we should touch them very easily. Over time, I think the prudential considerations would enter the picture, but that should be done in a cautious way and also coordinated internationally. And I think I'm finished because the next slide is on the pandemic, so we will do it later. Tim, back to you.
Yes, thank you very much. Yes, we will finish off with the pandemic, but there is so much to cover on this as well. And there are also so many questions. Thanks very much for your questions. What I will do is I will ask the others in the panel now. Thank you, Ignazio.
I should stop share. Should I stop sharing?
You could, yes, stop sharing. That's yes, exactly. We can share again when it comes later, but it's good to see you. And I'll ask the others on the panel for their response to any elements of what you've picked up, and maybe put in, ask you some questions each. Elga, can I start with you from where you see it at BlackRock? There is also a question that came in very early, from Herschel Ved to say, do you think that banking union will ever be able to surmount politics enough to be complete and inclusive? And I'd like your response to that as well.
Yes, thank you very much. So I think Ignazio is absolutely spot on that the completion of the banking union is of crucial importance, as is the capital market union. And it's both of those are easier to do, in my view, than the fiscal union, which most likely will require in its sort of full form a change in the EU treaty. But clearly, if we were to complete a financial union in Europe, of which the banking union is the key aspect, given the important role of banks in funding the economy, we would already make a very big step forward in our ability to cushion against asymmetric shocks or symmetric shocks like the one that we're seeing at the moment that is affecting countries to different degrees. Because both an effective banking union as well as a capital markets union offer key risk-sharing channels across countries, sectors, and jurisdictions. So that's a very, very important part. One thing that I would stress is that, also the discussion today focuses a lot on when banks are in crisis or when banks need to be resolved, which obviously is a key part of the work of the supervisors and the resolution board, the resolution authorities, and so on. But I do think there's also a lot that can be done in sort of the running of the regular businesses outside, banking businesses outside an acute crisis. And there, I think, is really where we have seen somewhat limited progress only in terms of the cross-border claims of banks, limited cross-border lending, and very limited cross-border ownership of banks. So I do think that when Ignazio spoke about efficiency and integration, these two could be progressing a long way if we actually dismantled some of the obstacles towards cross-border banking consolidation, which I do think is important for Europe.
Could you be specific what those obstacles are and how they might be dismantled?
Well, there are. It depends a little bit on the size of the banks. Obviously, for some of the smaller banks, they still fall under the national authorities. I think what we have, and there is, as Ignazio has said, there are sort of differences in treatments and how various rules are applied. I think there's also some political resistance for large-scale or large-scale cross-border banking consolidation. And I think last but not least, the ability to reap the benefits of consolidation, national or cross-border, also crucially depends, of course, on a range of other structural factors in the real economy as to whether you can, for instance, then downsize some of the operations in terms of the branch network, in terms of moving into the digital banking age, in terms of potentially also reducing staffing levels. And but I think this is a very important additional factor, because we cannot just sort of basically go from crisis to crisis and only review this either when Ignazio writes a report or when we have another crisis on our hands. But so this is another opportunity to revisit this with urgency due to the likely impact of COVID-19 on the financial sector. But that doesn't mean that when things are, going well, that there is nothing to do. So that would just be sort of my main point here.
Thank you. Jan-Pieter, I'd like to come to you because I actually have a couple of questions for you on this. Apart from your response to what Ignazio said, the importance of deposit insurance, because one of our advanced questions, very good idea to put in an advanced question, it's from Quentin Davies, or Lord Davies, actually, as I should appropriately call him. He said, is it not important to move to integrated deposit insurance? Otherwise, in a crisis, deposits will all move to the strongest perceived member state. That's a formula for turning a crisis into a catastrophe. Be interested in your point of view on that. And also an extremely popular question that's come in from Jan Vedigo Rademacher, who said that last year there were discussions in Germany about a merger between Deutsche and Commerzbank. How do you evaluate such thoughts from the perspective of the European Banking Union? And Ignazio, it assures me that you are very well connected in the German banking industry, so you'll be able to comment on that, I'm sure.
Yeah, so I should say something now, or Ignazio? I mean,
you should say no. You definitely you.
Okay, good. So yeah, thank you very much. I want to stress first that I'm really delighted to read and discuss a book that has been written by one of the persons who were responsible for designing and developing these infrastructures. That is not happening so often, and I wished it would happen much more often. In a way, also, I think for Ignazio, you try to give account also in some sense what you have been doing, and this and you share that with us, and I think this is great, and I'm happy to that this book is around, and there should be more of that sort. So that said, I want to take a viewpoint that is a bit critical of some of the basic results that are suggested in the therapy section. And that is, I start, I know I only have 2 minutes, so I will be very brief.
You can take a little bit longer, I'll give you 3.
So, but the basic question that I really have then for Ignazio is, what is the core idea of the BRRD, so of this view of the banking union, if you would put it more general? What's the core idea? And in my opinion, the core idea is bail-in, is to make banks, to reinstall private liability in the banking sector and take it out of the hands of governments, take it away from taxpayers and put it back in private pockets. And if you want to do this, and I remember very well a very early comment by Mathias Dewatripont on that issue, when we first discussed this, maybe more or less after the Krahnen report years ago, when he said, if you want to have bail-in, it will not be easy, or it will be difficult, right? Because there are so many restrictions, so many people who will lobby against bail-in when it should happen, that it needs a lot of force, a lot of determination by policymakers to make all these institutional details work smoothly so that you can rely on bail-in will happen. This reliance on bail-in, I would call it the credibility of these bail-in provisions, are absolutely key for whatever the BRRD and the banking union try to achieve, in my opinion. And to restore this credibility, I think that's the biggest need, or not to restore, to install this credibility. And in the book, Ignazio made a lot of examples why there is not such a credibility, why we don't trust in bail-in, why because in the crisis so many obstacles are there, governments intervene, and so forth. And I think this is something that one has to deal with. And in a way, Ignazio deals with it by saying, well, we shouldn't be so much pushing for bail-in. We should give more leeway for exceptions. And my comment is basically, my viewpoint is the exact opposite. And so I frame it as a question. So how will we ever trust the whole basic philosophy of bail-in if we try to expand the potential for exceptions? Make it easier, maybe I use your terminology, be more flexible in crisis. I mean, this all will be discounted by markets. And the whole idea that we make bail-inable debt expensive will vanish. Right? And if bail-inable debt once again becomes cheap, because everybody knows if push comes to shove, there will be the government intervening, then we are back at square one, where we were before the last financial crisis. Right? So this is my first point. We should push more, or I would like, my first point is a question to Ignazio about the, let's say, the philosophical dimension of bail-in in your argument. And my second comment is you make wonderful examples why you need a much stronger SRB. And I fully subscribe to you, whatever you say, it's exactly right. We have a very strong SSM and a very, I would say, latecomer in the process of resolution, SRB, who has basically not enough instruments, not enough power, and so forth. But what you are not doing in the book, and that I was a bit astonished, you don't say, well, why don't you put all this together? Why don't we merge SRB and SSM and deposit insurance? This is FDIC. Right? And then you would have many of these conflicts that you're describing would vanish. So these may be my quick comments.
And I need your comment on that bank merger.
Oh, okay. So
you don't escape, yeah.
Okay. So would you just repeat the direction of the question for this merger?
Yes. Which means I have to find it again. And yes, last year there were discussions about a merger between Deutsche Bank and Commerzbank. And from the perspective of the European Banking Union, how do you evaluate that? Is that important?
Okay, so I mean, there was so in last year when this merger was up, I was commenting myself on that issue, and I was commenting against it. I don't think that the strategy forward is to build national champions, because these national champions, and that was actually the argument used in Germany itself, is only the first step to government bailout, right? So because once you are a national champion, then national politics and everything starts to look at you as an important element of your infrastructure. And that's exactly the wrong way to go. The right way is go European with your banking industry and try to make banks resolvable and not too big to be not rescued, so to speak.
Absolutely. Thank you very much for that. I need to bring Mathias in because you've been very patient, Mathias, to get your response to what Ignazio says. Also on that idea of national champions, I'd imagine that would be something you would have some comment on. And then we'll come back to you, Ignazio. So Mathias.
Thank you. Thank you for the invitation. Thanks to Ignazio for writing a very interesting book. I agree with a lot being written there. In particular, I agree with the fact that at the beginning of banking union, there was a push towards higher solvency, and that was good. I was there only at the supervisory board until May 17, so 3 years ago. But we could see that while 2015 was still a push towards a safer and sounder banking sector, there was some pushback, well, by banks, but with some help by some, whom I won't name, to really stop this and saying, okay, it's enough. And this is where we kind of stopped. You could see that the wave was stopping. I understand from Ignazio that it hasn't restarted the push towards safer and sounder banks in a sense, even though, of course, broadly it was okay, of course, because the economic situation wasn't too bad, even if, let's say, there are a number of potential problems at the horizon, from fintech, big tech to low interest rates or low growth and all that. But clearly the view was we cannot afford to make the banking sector more solvent. The push towards higher risk weights, especially in non-Southern European countries, was also important there. So progress stopped, and unfortunately, when we get a pandemic, we enter a pandemic with a system which is not that strong. Now, of course, the pandemic, and we'll talk about that, has also meant that a number of the constraints have been suspended. But going to this thing about resolution, BRD, and so on, can I say that, and maybe there's a Belgian compromise sense, which is not always working, that I agree with both Ignazio and Jan-Pieter on this, in the sense that I agree with Ignazio that the current system doesn't work. We haven't used the 8% rule of BRD once. We have never gone since the beginning of the entry into force of the rule, which was January 2016. We haven't gone once beyond the stated guidelines of 2013, which is bail-in of equity, of course, but also junior debt. And by the way, I think it's a good idea, because we have, basically it doesn't work, and it doesn't work because the politicians wanted to say bail-in rather than bailout, and it's quite, everybody can only agree with that, provided it is credible. And this is where indeed I agree with both positions. Right now, it's not credible. We don't have 8% long-term junior debt to bail in without endangering financial stability. And I think I interpret Ignazio's point that, until we are there, we should be more realistic and do indeed restructuring of bank exit and all that with help from the public sector. And then we can reach the end result, which everybody, and especially Jan-Pieter, but everybody agrees with. Let's make bail-in workable. But right now, we have had this really strange situation. I like to say, when bail-in is not in and bailout is out, then kind of pretending things are not a problem. So denial is the only option. And that's what we've had with all these loopholes that we've used. And I think that was second best. It's obviously not first best. Hopefully, the pandemic, which makes bailout again tolerable, and it's good, even though BRD said even in a systemic crisis you shouldn't use it, which is crazy, and thank God it's not at all respected. Maybe let's have enough of a bailout this time to make sure that we can start with a credible banking sector where we can apply bail-in. I'm trying to be a bit provocative here, but I think that is, what we should do.
Can I ask you a specific question about that, Mathias? In the ebook, Ignazio comes out very much against the idea of ring-fencing capital for subsidiaries of international banks, national subsidiaries of international banks. And he specifically mentions Belgium in that case. Yeah. Where do you stand on that?
Let me be Belgian here, but not as a compromiser. I know, Ignazio I think we can agree to disagree on that one, and I will be alone here, but let me put it. Belgium is number 6 in the Eurozone in terms of the size of the banking sector, after Germany, France, Spain, Italy, and the Netherlands. And it's by far the most open. We have 50% of the banking assets that are of subsidiaries of other banking groups. The other 5, they are home countries we are home, 50% home and 50% host country. They are home at least 90%. So their markets are very close. And we know that it's not easy for them to accept their own banks, their own big banks, to be absorbed by other groups. This is why, before there was this discussion about, or roughly at the same time where there was discussion about the merger between Deutsche and Commerzbank, there was this idea that ING would take over Commerzbank. And they felt compelled, in order to be more acceptable, to say, look, but we will incorporate the group in Germany. Haha, that's a single market. Come on, come on. Right now, you know, Mervyn King famously said, banks are international in life and national in death. Let me say this, it's not clear yet. And in fact, bail-in will not help. It's not clear yet that we can't say that banks are international in life and national in resolution. And I have a lot of respect for the SRB, but you know, just like the SSM, there is pressure. And let's face it, we are not a full union. We still have a lot of intergovernmental points of decision. And therefore, I think it's only fair that Belgium is trying to say, look, there are a couple of things on solvency and on liquidity that we need to defend. Unless you really want to make it a true international organization, then switch from subsidiary to branch, and then you can do whatever you want. Because the externality will be gone. Again, I'm controversial here, but you know, this is about a debate.
This is why we invited you along, Ignazio. I come back to you. There are many things to answer there, but we can't get through all of them in time. But for a few minutes, and then for the last 10 minutes, we'll move on to looking at the future on banking union after COVID. So, Ignazio, back to you on any of the points that have been raised.
I think we are having a fantastic discussions. All the good points have been raised. I can be relatively brief because to some extent the interventions have answered to one another. The question of bail-in that Ian raised, we all believed a lot in bail-in at the beginning. We thought bail-in would automatically lead to discipline. Instead, Mathias has articulated that very effectively, it has led not to discipline, but to loopholes and obfuscation, because in the specific cases in which it should have been applied, either the banks were not ready because the balance sheet had not been properly restructured, there was no capital in resolution enough, or the national authorities, for social reasons or whatever, they were not prepared to do that because of the sensitivity of the issue. And so all the loopholes, all the ingenuities that I mentioned in the paper, in those 3 yellow charts that I have somewhere, have popped out. And that, you know, so you have a very good BRRD written in a certain way, and then the practice is not applied. And I think that should not happen. I would not agree with merging the supervision and the resolution. In fact, in the US, the FDIC supports a little bit the supervision, but all the federally chartered banks are under the supervision of the Federal Reserve. The reason why it's not good is that there is a little bit of a tension, there is a little bit of a conflict of interest, because the resolution authorities has to, first of all, can call a bank failing when they see that the supervisor is not acting soon enough. And so it acts as a control of what the supervisor does. And second, when it has to resolve, it should be free from the conditioning effect of having supervised the banks in life. So it has to be independent in order to treat the banking resolution in the proper way. So I think the presence of 2 separate institutions that cooperate and communicate, that's critical, of course, but are different, is international practice that should be kept. Actually, it was part of the original design. It was very, very intentional to have that. Now, the point of the ring fencing with Mathias, we've discussed that too many times, and we perfectly know the respective positions. But my question would be, I mean, I fully understand there is an issue of stability in countries which are predominantly hosts of banking activity, where the main offices are somewhere else, and then we have to guard for that. But this is a prudential issue. So why shouldn't it be left to the prudential authority, which is responsible, by the way? The ECB, in its statute, has the stability of the euro area financial banking system and the national banking system. So it's in the statutory responsibility to act as a prudential authority. So in principle, they should take care of that. I think that's all. I mean, Elga raised a number of points with which I fully agree. So I don't have to add anything at this point.
Good. Now I'm going to ask you in the time that we've got left, and I'm also going to I'm going to go on for a few minutes longer than our hour, if that's okay with everyone, because we do have a few things left to discuss. We have quite a few things left to discuss. Could you raise, Ignazio, the challenges that we're looking at the moment, the specific challenges that we're looking at the moment in the light of COVID-19?
Yes. Let me just show one slide left, which I have at the end of the presentation. Is this working? Wow, no. Oh, yes. Do you see it? Yes. Do you see it? Okay.
Yes.
So the pandemic, we all know that the pandemic is both a demand and a supply shock, macroeconomically, but it's already clear that it's predominantly demand and the overall effect is deflationary. And that will be so for a while, that we know. Both the bank assets and the liability sides of the balance sheets are affected. In a variety of ways. I try to spell out a little bit in a very conjectural way in the last section of the paper. So there is a big increase, I expected, and I think it's happening, a big increase in credit demand, mainly from corporates, not so much the household. The households don't spend, so they try not to borrow more. But the corporates are demanding a lot of credit. At the same time, there's lots of losses in the existing credits. Both of these channels will lead to a capital shortage. I try to quantify, very roughly in the paper, the overall at the peak, the total shortage in the order of 200 billion for the euro area banking sector under benign conditions. In particular, the fact that there is a relatively rapid recovery, which was the initial assumptions of the forecaster. Now it's a little bit more dubious. So, but that number is worth very little. But the only point I'm making it is to suggest that shortage cannot be filled by the internal sources of capital of the bank, simply because they are not making enough profits, and or the market, because the market is very cautious now. They don't know what's going to happen, so they're not going to offer. So that suggests that there may be need for governments to step in, subscribe capital and nationalize parts of the banking system, etc., to a certain extent. And the new rules of competition of the Commission allow that, and actually they foresee that. And the support plans that have been put in place in a number of countries, starting with Germany, include the possibility to enter into the capital of the bank. So that's a possibility. In terms of policies that we've seen lots of forbearance, and that's right. I think you have to forbear when the situation requires it, and that was done in the form of temporary waivers of certain requirements, not all requirements, but in particular some of the macroprudential buffers. Not so much the provisioning needs, as far as I can see, but in terms of the capital requirements that follows provisioning. Then the governments have offered public guarantees on new credits, not on existing credits, although they may need that as well, but one has to be careful. So both the EU in different channels and the countries have offered guarantees. And going forward, as I just mentioned a minute ago, there may be a need for direct subsidies and nationalization. My last point is on the exit strategy. I mean, and now we go back and think about the banking union. We have to, restart the road and, and cleaning up the ground. And so for the moment, we have lots of support, lots of forbearance, which is what we fought against in the past. Now is needed, but we have to be careful when and how quickly we take it back. And I think that I think it will be very difficult, because I know how much pushback you get when you try to be a rigorous supervisor, and I'm pretty sure that there will be a lot of pushback from the industry and from some of the authorities when some of the support measures will have to be withdrawn.
Ignazio, thank you very much. I'm going to send that back to the panel. There's a lot of things to work out here, and we have about 10 minutes to do it, so you're on the clock. I'll also throw in 3 questions from the panel, from our attendees as well. Lorenzo Binismaghi has noted that Andrea Enria yesterday said that banks are not lending enough despite the supervisory forbearance. So what are they missing? Werner Becker is talking about the impact of negative interest rates as a policy tool, and their impact on bank profitability, and the problems from that. And also one of our advanced questions, I note, Ignazio, in the ebook that you do not address Eurobond issuance. And so also I would like to bring that in. Basically, is that not important in this context? Elga, can I come back to you?
Yes, of course you can. Can you hear me?
Yes.
Perfect. Yeah, so a number of important points that you raised, Tim, and also thank you, Ignazio, for your additional thoughts on what this all means in the age of COVID-19. So from a macroeconomic point of view, I would first of all stress that how our financial system, and in Europe that means first and foremost the banking system, is able to handle this will be making all the difference on whether this is a rerun of the global financial crisis or not. Our baseline view is that it is not, and that even the most bearish forecasts out there in the marketplace at the moment would only imply sort of a medium-term loss of GDP, income, revenues, that is roughly half of what we saw in the global financial crisis, which obviously was followed by a decade of deleveraging and slowing trend growth. But so this is quite important, and to some extent, the fact that we are looking at an external shock here, no sort of overheating of the credit sector going into this, I think sort of supports this view, but we need to be sort of really attentive to any signs of stresses emerging in the banking system. In terms of bank lending, I think that the data that we see coming out of the European Central Bank show a material pickup in lending. It might not be enough on the whole, and there are of course, signs in the bank lending survey that sort of financial conditions have tightened, but I think we're very far away at this stage from a credit crunch, and we have very sizable, as Ignazio also mentioned, very sizable government guarantees, making sure alongside the measures that the ECB took, that the credit is flowing, and the credit needs to flow so that we can build a bridge across the disruption caused by COVID-19. So I think for me, that is very important. Have an effective bridge, which means money needs to arrive at households, at companies, which puts very much fiscal policy on the forefront, but also clearly the pipes of the financial system, which in Europe means the banking system, need to work. Just one quick comment to conclude on your question on Eurobonds. I do think that the proposals that we have on the table, the recovery initiative by the European Commission, and prior to that, the proposal by Chancellor Merkel and President Macron, are very important steps into the right directions. Clearly, these are not Eurobonds. They use an existing lending facility of the European communities to fund the joint response against COVID-19. So they're not really sort of meeting that common borrowing, nor do they assume existing country debt into a European framework, like maybe a comparison with the Hamilton proposal in the US might have suggested. But what this does, apart from being a clear show of solidarity in this difficult situation, is also that it creates for the first time a really sizable safe asset pool in the euro area, and sort of roughly on par eventually with the current outstanding volumes of bonds. So that's, I think, a very important step forward, and of course also helps with some of the issues that we discussed before on the sovereign doom loop. Obviously this is too small to completely solve that, but it's clearly a very encouraging step into the right direction.
Thank you, Matthias. I'll come to you now.
Yes, thank you. Well, first of all, I fully agree with Elga on the current initiative being a step in the right direction. So I think it's indeed very, very important. Of course, there will be a lot of general equilibrium changes with this pandemic, and the fact that the supply of Bund will increase a lot is, I think, something to keep in mind also, because indeed we have had a big change in fiscal policy in Germany. On the issue of the impact of this pandemic and all that, I agree with what Ignazio said. I think at some point it will be unavoidable to have recapitalization partly by the state. I would argue that it may be an opportunity to really make sure that the system can restart in a safe way, because we know from experience that the problem is not just is there enough lending, but the question is whether the lending goes to the right companies, and forbearance is of course a big problem. And you know, people are talking about temporary shocks and the like. Okay, some of the shocks are temporary, but maybe some of the shocks won't be temporary. Of course, there is a huge uncertainty about what's going to happen with this virus and with treatment, with vaccines and the like. But past experience shows that it may well take quite some time, and therefore the constraint of social distancing or physical distancing may be there for a while, and this may affect in a very structural way a number of sectors, and we need some rebalancing, and therefore forbearance can be a really big problem. So I think I would take advantage of the new flexibility on state aid to try and clean up the system and allow for a restart, because the evidence is overwhelming that this is the right way to go. We don't want to go Japanese after a financial crisis. We want to go Sweden or whatever in their financial crisis, and that's a hugely important way to go. Or we want to go the US way after the Great Recession, and not the US way after the savings and loan crisis.
Okay. Jan-Pieter, it's to you to finish us off.
Yes, I mean, there's a wonderful points being raised also by Mathias and Elga to have a long discussion on this. So maybe I make just two quick remarks. One is that the restructuring is actually something that everybody hopes and wishes for. I'm not so sure whether the recapitalization will be the way to do it, because this will invite a lot of behind the scene lobby activity, and I fear that the outcome will be even worse than the current situation. So I would rather leave this selection of institutions to a process that uses basically the competition and ownership structures that we have, rather than the governments in their intervention, which would mean less forbearance in that case. So that's my first remark. And my second one builds on what Elga said about it really is important how the crisis is handled technically in the next steps. And I want to point out that whatever you do to the corporate sector now, let's say by providing loans or whatever to help them through the crisis, has a mirror reflection in the banking sector, and that's where we face the next big problem, of course. And that is why I would argue we should have way more rescue programs in the form of equity-like instruments rather than debt-like instruments. And most of what we see now is debt-like and not equity-like, because with equity-like instruments in the funding of industry, we give a relief to the basically expected losses that comes onto the banking sector. And that would stabilize the banking sector maybe more than many other attempts of direct intervention at the banking level. Maybe I stop here.
We have to, I'm afraid, because we are over time. Thank you for staying a little bit longer. When you disappeared there, Jan-Pieter, I thought that maybe you'd gone forever.
No, I wanted to get a LAN rather than.
Thank you for coming back, but we do have to wrap up. We've got loads of questions there. You should all come back another week. Actually, this has been so good, and we've got so much to discuss. Yeah, come back again. I'll see if I can get you all back again. That would be great. But first of all, that is all we have time for here today. But there are many unanswered questions still. A lot of them are answered in Ignazio's ebook, and so if you haven't heard enough from him yet, there's 3 things you need to do, which is, first of all, download that ebook. You get it free from Vox EU as ever. Also, he did a column on this on Vox EU, which is called Beyond the Pandemic, 8 Proposals to Revive the Banking Union, which summarizes those 8 points that he made, and is a very good explanation of it. And finally, you can go to his blog at ignazioangeloni.home.blog. Ignazio, what is at your blog? What will they find there?
Well, don't take it too seriously. I mean, it was basically done for myself, because all my little contributions, article, etc., were all scattered in my computer and at the risk of being lost. Maybe it was not a big loss, but I thought I should keep them more in an orderly way. So I started to construct a personal web page, accessible only to me, with the help of somebody more literate in IT. And then at the end, it looked good enough, so I thought maybe somebody's interested, so it's open now. As you mentioned, it's Ignazio Angeloni, so first name, last name, all lowercase without dot, and then .home.blog, and there you find basically everything that I write or the interviews that I have, etc. You can download, etc. And you can also link to me or contact or even contact me by Twitter. I'm not going to be an active Twitter because I have a philosophical aversion towards Twitter, but that's a personal problem. But it's the possibility of that also exists.
And we do have quite a few questions today, Ignazio, that we haven't had time to deal with. So if there's any of those that interest you and provoke a response, maybe that blog's the place to do it. But thank you very much to everyone on the panel. I need to give us a wave to thank you. That's great. Thank you for everyone in the audience, especially all of you that stayed over time. I know that we pushed the hour a little bit too long, but we had such a great conversation to have, and there was so much to discuss on this, and it is so important. Delighted you stayed, and delighted that you supplied all those questions, and we hope that we dealt with some of the things that you wanted to hear about. But meanwhile, we hope to see you every Wednesday on our CEPR webinars. If you've got something that you want us to cover, let us know, and we can always plan it. And meanwhile, from me, Tim Phillips, all of us at the CEPR, and what I say at the same time on all of these, stay positive by staying negative. Goodbye.